Let me start giving my own thanks to those that have made possible the special issue and the conference, in very particular to my co-editors. I enjoy very much working with all of you. To all of you as authors, thank you very much for contributions. If you wouldn't have made these contributions, this special issue would never have come true. To the Journal of Financial Regulation and Compliance, I'm a member of the editorial team, and I think we have done a wonderful job. To St. Anthony's for hosting this conference, and to Ernst & Young for sponsoring. And before getting to the two panelists, they already have a wonderful job in introducing themselves, but I still would like to say a little bit about them. Let me just say a few words about the great financial crisis. I mean, my own take, and very, very short. I think that, as it happens with crisis, even in personal life, it's a perfect storm. It's a combination of different problems coming at the same time. And in this case, it was obvious there were large economic imbalances. A number of countries very affected by the crisis show large current account deficits. They were very dependent on foreign savings. These foreign savings were channeled mostly via the banking system. What we witnessed was a very high credit growth that also was much favored by the very low, if not negative, interest rates. And this, for example, was the very case in my own country, in Spain, where almost all the funding to the current account deficit, the foreign saving, was channeled through the banking system, and almost, to the euro, was financing the securitization of real estate assets. This takes me to the second factor behind this crisis, this financial innovation. This financial innovation often brought with it large information asymmetries, and the special purpose vehicles, I think they were a very good example, between investors and savers. An inadequate financial regulation, definitely regulators, we did a very poor job. We neglected a number of dimensions that came to the fore during the crisis. For example, liquidity. Liquidity was clearly neglected because there was ample liquidity. Nobody thought that this would come ever as a problem. And perverse system of incentives. And one of them, as Tom has said before, it was the lack of a credible resolution procedure, credible to the supervisors and the resolution authorities that their action would not play havoc in the market, and non-credible to the creditors that never thought they would take losses. The result was a liquidity and solvency crisis that this time had its epicenter in the most developed financial markets of the world, of the US and the European Union. And I think that this cartoon, that I like very much, represents very much how things would have been different if lenders, regulators, investors, and homeowners would have thought differently. Said that, and I think Tom pointed out this before, policymakers reacted to this disaster. First of all, central bankers play a key role, providing ample liquidity. Fiscal authorities, as you mentioned before, they did a very good job bailing out banks. In some countries, we still don't see that we will get back that money ever. And then we tackle very comprehensive financial reform, as you said before, in terms of the quantity and quality of capital, in taking care of and bolstering liquidity. And for the first time, I think there have been three elements here that regulators are taking seriously. First is the issue of shadow banking, defining, identifying the risk. Second, developing a macro framework characterized by three related dimensions. One is time, with the ultimate goal of smoothing the financial cycle. Although, I read yesterday a paper by Paul Tucker, published by the BIS, and he doesn't consider that this would be the adequate ultimate goal, and favors, for example, setting standards of resilience in the long term. A cross-section dimension with the aim of limiting contagion, and a structural dimension providing the right incentives. And for me, as you said before, what I call a Copernican change, and you and I will author a paper calling it the game changer, and I always compare in regulation to the discovery of Ptolemaios that it was the sun, that it was, and the earth was going around the sun, and instead of the other way around, it was putting together the too big to fail policy. This, I think, has been definitely quite a change. as I always say, finally regulators, we understood why we are regulating. It's because, you know, there is an insurance of the depositors because the role that banks play. This too big to fail policy had two elements to it. One is reducing the moral hazard. So this is policies that aim to reduce the potential that policymakers have no other option but to save an institution as a whole because of its size, important, or in general its systemicity. And second, and I think very important because banks live with that even without being in crisis situation, restore market discipline. And in this regard, I like to mention a report by the IMF, the Global Financial Stability Report in 2014, where they estimated the rating gain associated with government support of banks in different parts of the world. And what's very interesting is how the euro area banks, we're talking about 2014, enjoy a very large rating gain associated with this government support as compared, for example, the US banks. If we think 2014, Dodd-Frank Act had already been passed. Not only that, but the US have a structural early intervention and resolution, while in Europe still the bank recovery and resolution was not there. So said that, which is a little bit of my take, this session will focus on two particular aspects of the policy response. I will give the floor first to Oliver Frécault on the analytical framework to improve policy responses to systemic banking crisis. And then Tom will talk about the US response to the great financial crisis, and he will give us his critical view. I don't need to present any of the two because they have done a very good job to introduce themselves. Just my personal anecdote is that I have co-authored a paper with Oliver at the beginning, almost the beginning of my career, and I also been a proud co-author of Tom. Well, I still have a few years to go, but I'm facing also now the end of my career. So for me, it's a great honor that you accepted to come here and be members of this panel. Thank you to both of you. Oliver, the floor is yours.
Okay, good morning. Thank you, Maria. It's a great honor and privilege to be with you this morning. Of course, this is the customary disclaimer, and I mean it because I'm going to share with you some personal views. So please keep that in mind that I'm just talking in purely personal capacity here. Yes, my topic is, this is good. This is excellent. But we need to already think about the next step. We need to go beyond. We need to do better. And I will discuss what are the opportunities for further enhancement of the policy responses. And I will argue that the biggest potential is toward a more advanced analytical integration of macro-financial analysis, and that this will allow strengthen policy responses, and more importantly, this will address a problem that is annoying me a lot. There is a word here that is annoying me a lot as a practitioner of financial crisis for a long time. It's the word response. Response means that it's too late, that we're coming after the disaster. So we really need to also think about improve prevention policies. Let me keep my watch around because otherwise we'll still be here until tonight. So that I'm
and bear in mind that we're really late.
Yes, yes. And then I'll draw some conclusion from that. So yes, a lot of progress has been done in the wake of the great financial crisis, and our co-editors have produced an excellent editorial saying that policymakers have not let the crisis go to waste. But there are still opportunities to do better. And we can find these opportunities directly from some of the main lessons from the great financial crisis. And one of these key lessons is about the macro-financial linkages. This has been mentioned, particularly this horrific negative feedback loops. John, I'm sure you are acutely aware of that we've seen that as part of the work of the Troika. This macro financial feedback loop, it's a polite word to talk about a major catastrophe. And a key example that we are all very much aware of is that of Greece, of the way, all these major financial... and one of the key lessons of the crisis is that everybody now agrees about the criticality of the macro financial linkages. This was not the case before the great financial crisis. But we still have a problem. We have an issue. Macro financial linkages are still not well understood. And to mention somebody that you might have heard about, as part of this thing that we call the triennial surveillance review, Edouard, you must know this kind of thing, Christine herself was mentioning that we don't have a good grasp of that. And this was a 2014 discussion, but very recently, in the last few months, there was a more recent review by the IMF board of this issue, and they concluded that basically we still are facing the lack of integration of the financial sector with the other sector in our analytical work. So this is a key problem we need to address. And to address it, we need to go to the root. And the root is that macro and financial analysis are based on two different conceptual frameworks. Macro is based on national accounting and national accounting concept, whereas the financial analysis, prudential analysis, is based on business accounting and concept. The two can sound more or less similar, but actually they rely on two separate data languages. And the impact on the divergences is underestimated. Actually, there is some common vocabulary which is misleading. Les faux amis, c'est ce que nous disons en français quand nous parlons de certains anglicismes. And of course, the impact is far greater than has been so far imagined. So let me go through some of the key practical points in this regard. National accounting is meant for policy public purposes. What we are discussing here, it's a public good. Financial accounting, well, it's meant for business. Business has to be efficient. It's entitlement driven. It's the objective is completely different. So in the macro national accounting, there is a full symmetry required among transactions, which is not required for business accounting. And the practical consequence is that under national accounting, we have quadruple entries. Every time there is a transaction, there are two transactors, and you have 4 entries. Whereas in business accounting, we have only 2 entries, debit and credit. And of course, it means, and this is a key point, that by construction, financial transactions under the macro framework are wealth neutral. Whenever there is a financial transaction, there is no impact on wealth. Whereas in business accounting, you can have an impact on wealth. And it means that in macro accounting, financial assets and financial liabilities are always equal. Whereas we can have, and this is a source of trouble, a potential sort of trouble, we can have what we call orphan assets, financial assets reported by an entity that are not recognized as financial liabilities by another entity. So how do we go toward the macro-financial analytical integration? We rely on the national accounting concept. We focus on national wealth, on where is the wealth, how it's distributed, how it is changing. And we provide the missing linkages through what I call data bilingualism. So this is explained in some more detail, including the technical aspect in a paper I published last year, but a paper I had been working on for 15 years. I know Charles is aware of that. I even produced a paper after the Indonesian crisis, so this has been long into the making. This is based on national accounting. And then it has a starting point. The starting point is the global balance sheet, my dear colleague, of all of us as the human race. The balance sheet of mankind, the balance sheet for this little blue planet. We are going back to Copenhagen. And based on national accounting, this balance sheet is very simple. It consists only of net assets, real assets, and wealth. So, from this starting point, if we want to look at the wealth of nations, we have 189 members at the IMF, plus a few non-members like North Korea, the Vatican, or Cuba, yes. If we look at the wealth of nations, well, the wealth of nations will consist of only three items. Real assets, net claims on or liability toward other nations, and this is what we call the net international investment position, which is a key concept. And of course, net wealth. Then we can further disaggregate wealth based on this approach for the farm economic sector of the economies, and also for individual entities. For instance, a troubled bank that is on the verge of collapse, or let's say in China, an inefficient steel mill that employs 80,000 people. We can do the same thing. We can have this net wealth estimate disaggregated at any level for any entity. So, and this will actually help us to develop, strengthen crisis responses. How many minutes
You have like 5-7 minutes.
5-7 minutes. Okay. So I'll go very quickly through them. So the first thing we can do, we can better understand crisis of the past, which is quite critical. You know, like a kind of autopsy. And this applies to this applies to a case that Charles knows very well. We can identify silent distortions, which is a key factor to understand better the crisis, and we can have better targeted policy responses. And there are more details in my contribution to this beautiful piece of publishing. About the way of better understanding crisis, when I think one of the best cases is that of Indonesia, because there were some massive losses. The banks were recapitalized by the government, which means that at the end of the crisis, the banks were in the same position as they were before. But public debt has tripled. So the real question that the national wealth approach raises is what happened to the wealth of the country as a whole? And if you look at GDP, of course, it collapsed and then it recovered. Investment collapsed but did not become negative, even net investment after amortization. So, wealth accumulation must have slowed down, but not reversed, except, of course, for temporary valuation effect. So, if the banks are in the same position as before, if the taxpayer is poorer, whereas the country as a whole has not changed, what happened? Well, there was a huge, opaque wealth redistribution. And these are major policy implications that would need to be looked at in more detail. So this is the first contribution from the national wealth approach. The second one is the identification of distortion mechanism. I think you've all seen these cars that are running in a street and suddenly collapsing. You know, this is what we call a sinkhole. Well, crisis is a little bit like that, you know. Things are running smoothly, and then all of a sudden everything collapses. But it means that there was some hidden erosion, undetected for a long time. So where does it come from? And here the point is that it comes from bad quality investment, from inefficient investment. And actually, when there is large scale, of course, small episodes are not that large scale of sustained period of inefficient investment, we have this phenomenon of erosion. And actually, this is something that we discussed in some detail with Bambang Subianto in Indonesia, who was the Minister of Finance at that time. And if you look at it from the point of view of the national wealth approach, this inefficient investment is not investment. It's intermediate consumption. And the consequences, like you will see in the paper, are that here we have the national account as reported, is that if a large part of investment is inefficient and you have to reclassify it as intermediate consumption, then value added is smaller than reported. And what is value added? Value added is GDP. Value added is growth, which means the growth number that you see in some countries that report a huge growth are actually distorted. The real growth is far lower, and the crisis is just an adjustment, a return to the real number. So this is the second contribution of this new approach. A third one is the possibility to develop more targeted policy responses, and here you have a few details about what could be done in this regard. But I would like to go directly to my last, and I think the most important point. Responses, yes, but prevention is really what we need to focus on. We need to do something before we have a problem. And to improve prevention policies, we can work toward risk identification and monitoring. We can have more decisive early remedial action. And we can broaden our monitoring of key countries. Risk identification and monitoring, there are a number of things we can do, like developing new ratios, or look for these orphan assets. Assets reported by some entities, but not recognized as liability by others. An example, the Greek banks, more than 50% of their capital base is made of deferred tax assets. They report it as assets, it's part of their equity, but nobody in the economic system is accepting it as a liability. So these are these kind of orphan assets that are a major risk for financial stability. So then we can monitor signs and do a number of things. We can have a more decisive remedial action based on a broader mandate. We can do a number of things. This is still very preliminary, of course. But then I think a key point is to have a broadened monitoring of key countries. In the US, as part of the crisis, of the failure of Lehman Brothers, I think it was a 160 billion bankruptcy. There is a reported huge destruction of value. But seen from the national wealth approach, there is no destruction of value. There are some transfers, immediate of delayed recognition of past transfer or correction of wrong numbers. So this would be worth reconsidering. We could look more at the deeply negative net international investment position of the US. This deserves a closer look. And we could also look at the problem of reported corporate profitability. There is somebody that some of you might know here. His name is Andrew Smithers from the Financial Times, who has a blog, and he has made a comparison of the profit of the main US corporation as reported as part of their quarterly reporting as listed entities with the same number from the national accounting. And they don't match. There is a big discrepancy here. So this might be a time bomb for the US. For China, of course, there are some very serious questions, particularly how risky is the corporate credit expansion, and if the large buffers that they report are accessible or not to provide protection in case of a crisis. And they've done a lot of work on the national balance sheet in China. It's done by the Chinese Academy of Social Science. They have created an institution for financial development and even a research center for the national balance sheet. And a book, information is not easy to access in China, but there is a book when there is a lot of valuable insight here, prepared by Andrew Sheng, that some of us know from his time at the World Bank as an expert. And it's a book that we had the opportunity to discuss at the IMF last year. And he has shown a very amazing number about the way China is accumulating reported national wealth. to the tune of $6,000 billion every year of additional net wealth. So this raises a number of questions that we don't have time to deal more into here, but that would deserve a far closer look from relevant people in the international community. So let me conclude, Madam Chairperson, sorry. There are opportunities. This is good, but we can go beyond. And we should, in particular, focus on opportunities to improve prevention. The national wealth approach, described in my working paper and also in my contribution, has some potential that has been verified preliminary to this stage in some key countries. And actually, it might be time for what we call a global balance sheet initiative to provide a comprehensive and holistic framework for this overall approach. And we will have a seminar on this topic in Indonesia. It was supposed to be in Bali in a few weeks, which would have been nice, but because of a troublesome volcano, we'll go back to Jakarta. And the keynote address will be given by Andrew Sheng, the author of the book that I just represented it. And actually, the title of his presentation is A Global Balance Sheet Initiative. Thank you very much for your attention.
Thank you, Oliver. Thank you so
Thank
much
you.
for also keeping to the time. Tom, the floor is yours. You have 20 minutes.
What I'd like to do is give a few, thank you, perspectives. The U.S. response in the regulatory area is driven, in my view, from two aspects. First is the crisis is very largely the result of poor risk management on the part of the banks, and the risk-taking on the part of the banks aggravated, perhaps initiated the crisis. And there is a compounding of that with respect to the compliance issues and the behavior of the bankers. So the compliance shortfalls, of which there are undoubtedly many and grave, created the basis or strengthened the basis for the conclusion that the crisis was very largely, if not totally, the fault of the actions of the banks. As a result, the response, at least in my view, is focused very largely on tightening up regulation and supervision to prevent failure, to reforming resolution policy to reduce the impact if a bank should fail, and above all, to limiting the amount of public support that could be provided to either banks or other financial institutions, and indeed to anyone who is not a U.S. institution. The political reaction to the crisis was quite vehement. The Congress got very rapidly into action and passed the 2,200-page Dodd-Frank bill, as is well known, in 2010, instituted 240-plus different regulations on top of that. So there is a huge amount of regulatory response. Not all of it is well accepted. Indeed, in the current environment, there are some. There's a large body of thought that would say that the reform has not been strict enough, and I'll come to that in a moment. The supervision has been strengthened. Again, as I said earlier, a great deal of emphasis on prevention in the micro sense, not in the sense that Olivier was talking about, and focus on stress tests and really the use by the Fed of the stress test as a weapon to make sure the banks take into account the possible adverse. Yeah. They on the There are some blind spots, however, and I would put into the category of what could be improved a number of different things. Perhaps not quite so cosmic as you've alluded to. The first is reform of housing and housing finance. By most people's reckoning, Fannie and Freddie had something to do with the crisis. Fannie and Freddie continue to subsidize the U.S. housing market. The federal government is making tons of money month in, month out. The desire to reform the U.S. housing market seems to be completely absent from the U.S. Congress and the U.S. Administration. But it is also absent, largely absent, from the financial stability risk boards that exist in various different guises. So the apparatus of financial stability risk boards is a great tool, but are they confronting some of the real issues? Are they confronting the political taboos? No, by and large. Housing finance is an example. Concentration risk in government bonds in the Eurozone is another example. Interest rate risk in the banking book. So there is a large element of in the financial stability risk boards of very insightful work about issues that do not relate to the fundamental assumptions that are being made about the creditworthiness of governments. In other words, there's a reluctance to attack the holy cows. And that, in my mind, is a particular problem, because it is the assumptions that often give rise to the problems, the assumptions that turn out not to be true, the assumptions that housing prices in the U.S. could never decline, being a good example, the assumptions that government bonds don't bear default risk, a strange thing to still stick to after the restructuring of the Greek bonds, Greek government bonds. But it's also at the very heart of the macroeconomics. You mentioned macro financial linkages. One of the elements in the crisis was an assumption that one didn't have to look at the financial sector when modeling the economy in order to determine monetary policy. Indeed, the financial sector was completely absent from most of the models that central banks use to determine monetary policy. Also the division between supervision and financial stability. The supervisors are perhaps rightly criticized for having lacked foresight at the time of the crisis. But I would suggest if we run an experiment, had the economy actually performed the way that the central banks forecast it would have performed, even as late as the final quarter of 2007, we would have had a very different picture. And so those forecasts indicated an economy that would continue to perform relatively well. They didn't see a fall off in output and employment. They didn't see weaknesses in the market. If one's looking for things to do better and a research agenda, a policy agenda, I would agree fixing macro financial linkages is quite important, and it is not only on the area of data, but I would submit also in the area of theory. The particular resolution solution adopted in the States, so-called Title II, a special resolution regime, is open to much criticism. There is quite a movement to repeal this Title II. It is nice in theory, but it would be, in my view, troubling in practice. It is a mechanism that is particularly suited to the U.S. structural environment, where you have a parent holding company and a bank subsidiary, a structure that would allow the bank subsidiary to continue in operation, put the parent holding company into the equivalent of bankruptcy. It is a mechanism that, let's say, market participants think could work. It is one would only actually know if it would work if it came to that. But it is, at least in my view, it would be a very brave step to simply repeal that without the confidence of something in its place. So, in particular in the U.S. environment, it is there is a solution. It admittedly has not been tested. There is no appetite, and rightly so, to go out and test it, have a big bank fail just for the sake of seeing whether the resolution mechanism works. But pardon my expression, but screwing around with it is, unless one's very confident about the replacement, is not a terribly good idea. The other reaction that is questionable in my view has been the constraint on the Federal Reserve from its liquidity granting powers. Admittedly, the Federal Reserve under Governor Bernanke fully explored the Federal Reserve Act and all of the different possibilities that the Federal Reserve Act gave to extend credit to non-bank financial institutions. I seriously doubt that in 2004 anybody imagined that the type of extension of credit that the Federal Reserve made to AIG would have been envisaged by the writers of the Federal Reserve Act. But it was there, it was implemented, it was very effective, it was the right thing to have done at the time. That power no longer exists. It is questionable in my mind as to whether the wisdom of having given up that degree of freedom for the central bank to intervene. So you have a constrained Federal Reserve and one that is potentially going to become more constrained. Perhaps a final word to allow us to get to discussion. The resolution debate, financial services regulation, crisis prevention, valuation plays a key component. The data is one thing, the raw amount of data that comes in, but what value is placed on it, and what is the basis for that valuation? And nothing exposes the importance of that question more than a crisis. There is, if we had to sell our house this afternoon, and complete the sale this afternoon, if it could be done, I would say it would be at a price far different than we would anticipate getting for a normal sales process. If you're forced to sell assets and throw them on the market, you expose yourself to that same type of criteria. And in a market environment, the reduced price that the fire seller gets has an impact on the valuation that all of the other participants in the market have with respect to collateral, with respect to mark-to-market, with respect to capital calculation. And that is in my view, one of the key elements that has to come into play, and that, in my view, is why liquidity is so important. Liquidity provision, above all, from the central bank. And I think at the end of the day, it is liquidity and that matters most with respect to financial crises. And it is the liquidity, the source of the liquidity at the central bank that is effectively the only game in town when you come down to it. Do the central banks have the capacity to lend? Do they have the mechanism to put it in place? Can they take the security? Do they have the processes in place? And as Governor Bernanke put it in his book, do they have the courage to act and the political ability to act? Those issues, I think, will stay with us for some time. Those issues are not necessarily susceptible to legislation or regulation, and those issues depend very much on the people in the positions who have to make those decisions in very short order, and the appointment process by which they are put in place.